All right, let's talk Union Pacific. They just dropped their third quarter earnings, and honestly, the numbers were fantastic. We're talking record-breaking stuff, but the stock dropped. So what's going on here? That's the big disconnect we're going to unpack in this explainer.
So here's the central puzzle, right? You've got Union Pacific delivering what you'd call a textbook beat. They're setting all these operational records, and yet the stock sells off by over 2%. It just doesn't seem to add up. So what on earth is spooking Wall Street?
Okay, first things first, let's get into the numbers. And on paper, wow, this was pretty much everything you could ask for from a top-tier railroad. So their adjusted earnings per share came in at $3.08. And that was a really solid beat against what analysts were looking for.
And check out the top line revenue. Hit $6.24 billion. That's up 3% from last year. In this kind of tricky economic environment, that's a really strong performance.
But here's the number that really got my attention, the one that screams efficiency. Their adjusted operating ratio, which, if you don't know, is a super important profitability metric for railroads, it improved by 180 basis points, down to 58.5%. I mean, that is absolutely industry-leading stuff. So this table really lays it all out, doesn't it? You can see revenue was basically right where everyone expected it to be. But the earnings per share? That blew past the consensus by about 9 cents. No matter how you slice it, that is a clean beat, a really strong quarter. So you're probably asking, how did they pull that off? Well, this incredible financial performance was all thanks to what was happening on the tracks. Let's take a look inside the engine room, so to speak. I mean, just look at this. The team set best ever quarterly records pretty much across the board. Car velocity, that's how fast the cars are moving, up 8%. Terminal dwell, basically how long cars are just sitting around, down 9%. And on top of that, they set records for train length, fuel consumption, and how productive their workforce was. Look, these aren't just fancy stats on a slide. Every single one of these improvements translates directly into cost savings, which goes straight to the bottom line.
And this quote from their chief operations officer, Eric, it just says it all. Perpetual dissatisfaction. That is their mindset. It perfectly captures the kind of culture that's driving these historic results. They are never satisfied, always pushing to be better, to optimize every little thing. Okay, but here's the twist. All of this incredible operational work, it's being totally overshadowed by something else. The market right now, it doesn't seem to care about Q3. It's focused on one single, massive, company-defining event. And that event is the $85 billion proposed merger with Norfolk Southern. We're talking about a deal that, if it goes through, would create the first ever U.S. transcontinental railroad. This would completely redraw the logistics map for all of North America. It's a huge deal. And this is where the real battle lines are drawn. On one side, you've got management's pitch. They're saying, hey, this creates one seamless network that can take on the trucking industry and the big Canadian railroads, making U.S. rails more competitive. But on the other side, you've got fierce opposition from their rivals and this huge looming regulatory review by the Surface Transportation Board, the STB. And that just injects a massive amount of uncertainty into the whole situation. Now, the CEO, Jim Vena, he was not shy about this on the earnings call. He was super confident, almost defiant, you could say. He basically argued that all the complaints from other railroads, that's actually the proof that this deal is good for competition. His message to regulators is pretty clear. My rivals are complaining because they're scared of us being a stronger competitor. So it's no surprise that this merger just completely took over the analyst Q&A. I mean, you could tell management wanted to talk about their fantastic quarter, but pretty much every single question ended up circling right back to the deal. So in that Q&A, they basically laid out their 3-part strategy to get this thing approved. Step 1, build support. And they're already on it with over 400 letters from customers and some key union deals locked in. Step 2, deal with the rivals. They've got a plan to offer track access to the very few customers who might lose a shipping option. And step 3, the timeline. And it is aggressive. Vena is pushing his team to get that formal application filed with the STB before the end of November.
All right, so where does that leave us for next quarter and beyond? Let's get into our take and what we think you should be keeping an eye on. So looking ahead to Q4, management did give a little warning. They said volumes are running down about 6% right now, mostly because they're up against some really tough comparisons from last year. But you know what? Honestly, those short-term numbers barely matter at this point. The real driver, the only catalyst that counts, is that STB filing. This stock isn't trading on operational performance anymore. It's trading purely on merger news. Every headline, every hint from the regulators, that's what's going to move the needle.
And all of that brings us to our final rating, market perform. And look, this was a tough call. From a purely operational standpoint, Union Pacific is a world-class company, one of the best-run outfits out there. But the risk from this $85 billion merger, it's just too big to ignore. It's a classic binary event. It either happens or it doesn't, and that creates this huge cloud of uncertainty hanging over the stock. We think that's going to keep a lid on any real upside until we get a lot more clarity from the regulators.
So there you have it. That's our breakdown of Union Pacific's very interesting quarter. And just a quick reminder, as always, this is not financial advice.